welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, Josh Schaefer in for Josh Shapiro today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
When you look at the reliable earnings growers, these companies check all the boxes. And if you're worried about a slowing economy, I'd much rather own these companies than traditional defensive. I think technology, big technology, are the new defensives. And if you look at free cash flow, although they've been criticized for spending, large CapEx budgets, the free cash flow they're producing is unbelievable. It's much bigger than most countries.
Elon Musk has been in regular contact with Vladimir Putin and other Kremlin officials since 2022, right up until the spring and summer. Wide-ranging talks about business, about personal stuff, and of course about Ukraine. And we had two sources who told us that Putin actually asked Musk not to turn on Starlink over Taiwan as a favor to the Chinese president, Xi Jinping. And of course, Putin is in some debt to Xi Jinping for his help and support on Ukraine.
There's a very big difference between a Trump win and a Harris win, from corporate tax policy, individual tax policy, energy. So I think there's going to be some adjustments if there's a definitive winner come November 5th. So if there's not, I think that's what everyone's scared about. You talked about people buying gold, Bitcoin. I think those are catastrophe hedges because if we have an undecisive election, no one knows what's going to happen.
To go until the market close. So let's take a look at the major averages here. We got a mixed picture today. We've been talking about this a lot this week, that, it's earnings season. You got a lot of big individual moves, but not necessarily a lot of unified macro level moves. And this is the same thing again today, down 174 points, 175 or so on the Dow. The S&P 500 up about 1/5 of 1%. And the Nasdaq is leading gains up about 3/4 of 1%. It is worth mentioning, but a couple things. One, the Nasdaq actually hit an intraday high today, right,
First
Josh?
time since July.
I don't know if it's going to close at those levels.
Nope, it's teetering right around where it would need to be at a record. So we'll see if we get a little bit of a late rally, we might have it. Yep.
And then the other thing I want to mention is what we're seeing on the week here, which is that the S&P 500 has risen for 6 straight weeks, but that streak ends this week.
And when you take a look, Julia, we were talking about with the individual stock moves, just how much more that has weighed on the Dow Jones Industrial Average was something that stuck out to me. And then you flip over to tech. I believe the Nasdaq is up on the week, though. So it's been a week for tech, really, obviously, as you see, kind of post-Tesla, right?
Yeah, ironically, too, before we even get into the Mag 7 earnings, right, you see this outperformance. So we'll see what happens as we start to get more of those. But speaking of the Mag 7, let's take a look at the Nasdaq 100 and how we see that performance. A lot of green in the Mag 7 today. I don't know if that reflects anticipation, excitement over the numbers starting to come next week. But nonetheless, we also are continuing to watch the market cap race, right, between NVIDIA and Apple.
Yeah, it looked like NVIDIA, I think, passed Apple at one point earlier today.
A moment,
very slightly. Of course, in the grand scheme of things, I'm not really sure how much that all matters anyway. But I think overall, one thing I'm interested in is what you mentioned, Julie. A lot of these stocks trading near 52-week highs, some of them all-time highs, and it'll be curious to see how they perform off of earnings. I'm looking specifically at Apple there, very close to a 52-week high. They've kind of had a rally recently. Can they still rally off earnings after that? I think is going to be interesting.
Yeah, and it is notable how much strength we have within the large cap tech. We also have some strength in semis that is happening today. All of the stocks except for one that we have on our board here, our heat map here, are trading higher today, and in some cases by a pretty decent margin.
We will learn plenty more about semis next week as we keep talking about AI. That's
yes,
for sure.
We will.
All right, but for more on the latest market moves and for what to watch as we approach a big week of earnings, let's welcome in Zachary Hill, Horizon Investments Head of Portfolio Strategy. Zach, I want to start with where we're at right now with the market. Julie and I were just talking, close to record highs in the S&P 500, close to record highs in the Nasdaq. Big week next week, a lot of eco data coming out. You have big tech earnings. What do you think is going to drive the market over the next week or two here?
Yeah, I mean, the next 2 weeks are like the Super Bowl for investors, just one after another after another. So, I mean, next week we get 5 of the 7 Mag 7 names reporting. That's obviously a huge deal, not just for the Nasdaq and related indices, but also for the S&P 500, just given how large they are. And that kind of debate back and forth between, are we going to get a more cyclical kind of rebound because the economy is stronger, or more of that kind of defensive growth trade that we've seen really over the last 18 months. Couple that with all of the jobs data we get next week. So obviously we get non-farm payrolls on Friday, but then also the JOLTS report, is one that the Fed has looked to as something that's very important for assessing overall health of the labor market. So, those are, and we get the first cut of GDP for Q3, which admittedly is backward looking. Investors don't really care that much about that. I think the jobs numbers are much more important, but really quite a lot of data next week. And we're not even talking about what's occurring the week following.
Yeah, you mean that thing on November 5th that we're looking ahead to? Is that what you're referring to, Zach? Okay, well, put all this together then. Do you think that stocks continue to be able to rise in the face of all that stuff?
Yeah, we do by and large. I mean, we've really repriced interest rate expectations over the last month and a half, really since the 50 basis point cut that got everything going in September. And there's a lot of reasons to worry. Rates are higher. What about political uncertainty? All this sort of thing. And really, when we cut through a lot of that noise, we focus on primarily on the health of the underlying economy, because that's going to drive earnings, and ultimately that's going to dictate the path for risk assets. And we still see that, broadly speaking, as being something that's very supportive. I mean, I think we saw a little bit of a trough in some of that labor data. And that's what was driving defensives to outperform in Q3 and driving interest rates to fall. And we've reversed a good bit of that that path in the last few weeks. And we do think that makes more sense for stocks to work their way higher. Now, what happens over the next 2 weeks is obviously going to depend on all that stuff we talked about before. So that's a little bit of a more it's a harder call to make.
Zach, you mentioned
into the end of the year and through next year, yes, we continue to see broad upside for equities.
And you mentioned rates moving higher there. I think the 10-year's added about 50 basis points since the Fed enacted that interest rate cut. It's really chugged higher, along with also the economic surprise index. I was looking at a chart looking at both of these, right, and it's been better than expected economic data. It seems perhaps at least somewhat contributing to what's driving yields higher. I guess as an investor, what's the takeaway from that? If economic growth is what's driving yields higher, does that not make it a headwind for stocks? Or at some point, are we still talking about a higher 10-year potentially being a headwind for equities?
Yeah, I mean, I think there are two things that matter, multiple things that matter. I mean, one is obviously the level of rates is going to impact long-term discounts. So that's going to have a discount factor impact on how you value equities and what the fair value multiple should be. But the other thing I think is probably more important and gets lost in this conversation is, why are interest rates moving? If rates are moving down because the Fed has got to cut more because we're going into a recession, that's not good for equity markets, even though policy is going to be easier. Conversely, if interest rates are going up because economic growth is stronger and we can live with higher interest rates, the economy's steady state is just a little bit higher than it was in the 2010s period, which certainly is the way that we lean in terms of how we're thinking about rates, then that's not a bad thing for equity markets. That's actually quite a good overall environment. I mean, a lot of the 90s were characterized by environments that look a whole lot like that. So those are some nuance around rates. I mean, the last thing, and some of the, maybe this last week, there's been a lot of talk about fiscal sustainability within the U.S., almost regardless of what happens after the election. And so that is a type of scenario where you have rates up for kind of the wrong reasons. And broadly speaking, we wouldn't expect equity markets to react well to that. If you need higher risk premia, for U.S. debt, well, that just stands to reason that you're going to pay less, for U.S. and other equities in that type of a world. So that's something that we're watching. It's also people have been talking about the U.S. fiscal sustainability situation over my entire career, and it has never really mattered outside of just a few isolated instances. That
lots of people like to say it's going to matter at some point when it does, but you're right, it hasn't yet. You mentioned that people have been sort of now rotating back out of defensives, and I know you like growth here. Obviously, Mag 7's part of growth, but why do you still like growth here? And is it going to be earnings that are going to be the next catalyst for that group?
Yeah, earnings are really important, obviously to continue to beat and raise, especially for the, very high expectation semi companies that are involved in the AI theme is something that's really important. So, watching the hyperscalers next week and what their CapEx plans are is going to be really key for that part of the AI trade. But really, since the kind of June, July period, we've seen, some growth leadership kind of downshift into a little bit of a different kind of environment, of broadening out, so to speak, of the AI theme. So not just the picks and shovels chip producers, but some of the hardware and software enabled companies, cloud services providers, that type of thing. We broadly view that as a healthy development for the overall theme, and we do think the scope and the impact of AI on the economy is still very early innings. And so don't give up on U.S. growth kind of no matter what this earnings season looked like, but it may be a little bit of a different kind of market environment than we saw over the last 12 or 18 months.
Zach, thanks a lot. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, a sandbagged handbag deal. We'll talk about what's next for Capri and Tapestry after a judge scuttled their $8.5 billion deal and which stock you might now want to buy. Stay tuned. Much more Market Domination still to come. Capri Holdings and Tapestry stock, they're headed in very different directions today. Capri, the parent company of Michael Kors and Jimmy Choo, is plummeting after a U.S. judge blocked its $8.5 billion acquisition by Tapestry due to antitrust concerns, while Tapestry, owner of Coach, is moving higher, with the company planning to appeal the decision. So are either Capri or Tapestry stock, are they worth holding on to? Joining us now, Anisha Sherman, Bernstein senior analyst. Anisha, it's good to see you. I guess we should mention, first of all, that this situation is not entirely over, right? I guess there's still a sliver of a chance that this would go through, but what kind of odds are you putting on the deal actually happening at this point?
Right. So what's happened now is the FTC has challenged the merger. It's gone to court, and the judge has ruled in favor of the FTC. The defendants are now going to appeal. So there's going to be an appeal process that is likely to take several months, probably not resolved until early next year. And then separately, there's an FTC's internal administrative hearing, which is likely to follow the FTC's initial opinion. So the real question is, can this be overturned in the appeal? But another confounding factor is on February 10th, 2025, that is the outside date. That is sort of the final date at which, if nothing is done by then, if the deal isn't closed by then, either party can just walk away. So essentially, either of the two, whichever comes earlier, either a final decision or February 10th, 2025 is going to be the end of this process.
So is that still a headwind on Tapestry stock then, Anisha, or is that something that you think won't necessarily be that big of an issue moving forward?
So technically, yes, it's still up in the air, but it feels like now the odds have heavily shifted in favor of the deal falling apart, which is very good for Tapestry, because in the kind of 15 or so months since this deal was announced, Capri, the company they were hoping to buy, has had deteriorating performance every single quarter. And so it's looking less and less appealing as an asset to purchase. So this is very good for Tapestry stock that this deal is likely to fall through.
And now, where does Tapestry go for? I guess I should ask what this means for both of them, right? Like Michael Kors stuff came out as part of discovery for this this whole process, that the bags were selling at steep discounts, and that's also part of the calculation that I know you're making. What happens to that company now?
There's a lot of debate about Capri because we haven't actually heard from management. Management has not talked to the street in over a year. They haven't been talking to the sell side or to investors since this deal was announced. So we haven't heard from them in about 15 months. So it's hard to know what exactly their strategy is. But the debates are now about whether they will separate out the company, sell off the two higher end brands, Versace and Jimmy Choo, and have a kind of smaller, cleaner, single-branded company, which is just Michael Kors, which is what it was like about 6 or 7 years ago before they bought these two brands. So that's the debate for Capri, and potentially that could add some upside in terms of what kind of sale price they could secure.
Anisha, for Tapestry, this is a deal that's being blocked, right? It's not like they're backing out of the deal. So you would have to think that there was, at least at one point in time, something that was attractive about this, something that they felt was going to be additive to their business, right? Are they going to be able to build whatever that was internally, or is that just not going to be something that plays out? How does that work for Tapestry as a business?
Yeah, I mean, they were looking at the next few years, and we're looking at a path of organic growth that could have been very slow, or a path of acquisitive growth that could have got them a leg up faster, particularly the Versace brand, which has been really under-delivering, underperforming under current management in Capri. Tapestry felt like that was a kind of an easy win where they could very easily scale this brand up. It already has very strong brand equity, very strong brand awareness globally, but really low market share and really low margins. So it just essentially needs better management. So they saw some opportunities there. Similarly with Michael Kors, they saw some opportunities to better run that business. And those opportunities now have gone away, but I think they can still get organic growth. It's just a slower path to getting global growth than if you had this 6-brand portfolio that could drive growth faster in all the markets.
Well, speaking of maybe re-accelerating the path to global growth now for Tapestry, if indeed this deal for Capri is going to happen, Bloomberg columnist Andrea Felstad, for one, today suggested that maybe Tapestry should look at Burberry as a potential acquisition. Does that make sense to you? Do you think Tapestry should be looking now elsewhere for acquisitions?
I think theoretically, strategically, that deal would make sense. It would give Tapestry access to a new market. Burberry is biggest in the UK and in parts of Europe, where Tapestry has a very small presence. They only do 5% of their sales in Europe. So it would give them a complementary market, a kind of similarly priced, like near luxury, affordable luxury brand. Burberry also has a strong presence in handbags, so there's some cost synergies. I think the challenge is just timing. I mean, right now, Tapestry is not going to be embarking in any new conversations because, as we said, the deal isn't completely off yet. So we need to wait until that decision is final. And then it's the question of, can they present to the board another recommendation for M&A on the back of this ill-fated deal that has suppressed their valuation for a year and a half? I don't know if the management and investors would really be open to that right away. So I don't know if it would be an immediate pivot to another shopping expedition. I wonder if they will grow a little bit organically first, reassess, and then think about next steps.
Makes sense. A little pause. Anisha, great to see you. Have a good weekend.
Thank you. You too.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Footwear's in focus today, led by Deckers, riding higher on the back of their latest earnings report that saw the company top expectations and raised guidance for 2025. Skechers, a bit of a head scratcher there because that company reported earnings that beat and actually raised its forecast, but those shares are taking a hit. In terms of Deckers, I mean, it just continues to have hot shoes. Uggs have kind of dipped and then come back, and Hoka's are hot.
Yeah, it seems like every quarter we're looking at this report and it's, Hoka sales are doing better than you thought. Hoka sales are doing better than you thought. I couldn't help but read through this report and think about Nike and think about the read through there of Hoka's continue to get more and more popular. They have so many. Hoka coming into the running shoe competitive space, right? How that's weighed on Nike. Can Nike find a way to create something like Hoka? It feels like whatever Hoka is doing with that product mix, I know people like the shoes and find them comfortable, but there's something with that product where some of the other bigger retailers just haven't been able to find the right fit to really have a shoe that competes with it.
Yeah, even though you see all of the shoe companies chasing each other with that silhouette, I always bring up my husband who has 6 pairs of Hokas, which is kind of nuts, but that's what, people have 6 pairs of Nikes and no one thinks anything of it. I will point out when you make the comparison, Hoka's sales this quarter were about $571 million. Nike sales last quarter were about $11.5 billion. So it's much smaller, but the discussion share that they're getting, considering how small they are, is also just really interesting.
Just walk around New York City.
Yeah.
You see more Hokas sometimes now than Nikes if you walk in a park. It stands out to me every time. It's very interesting to see that sort of shift.
Yeah, you've seen an uptick in that and ons. A lot of people have.
On stock also up today, I think about 6% last time I checked. We're going to move on over to another stock. Shares of Newell Brands soaring higher today following their latest earnings report. Despite a split on the top and bottom lines, the company raised its full-year EPS outlook. So, Julie, margins hitting their highest level since 2020 here, boosting that 2024 EPS guidance up to a range of 63 cents to 66 cents. That's up from a range of 60 to 65 cents. So a small move there, but perhaps signs of a little bit of a turnaround here.
Yeah, and they've been trying to turn around the company. They own a pretty broad portfolio of brands. They own Yankee Candle. They own Sharpie pens.
No Crock-Pot mention on the earnings call. I was disappointed.
I forgot that they own Crock-Pot, yes. And it's interesting, on the conference call, they talked about not necessarily taking price increases on their sort of base products, what they call their base products. They said they're driving productivity benefits through the supply chain. So sort of taking cost out, I guess, where they can. And investors seem to like that quite a bit.
One other nugget from that call that stuck out to me, too, Chris Peterson pointing out, he's the CEO, pointing out that he thinks that holiday sales are actually going to be higher this year, but it won't necessarily benefit their business. He mentioned that it might go to food and other more essential items, but a little bit of a hint there at the overall macro holiday outlook. He said their channel checks are showing that holiday sales higher than last year. So still consumer spending going on there.
Right, definitely. And then also let's talk about some healthcare stocks. Again today, some big movers. Shares of Centene getting a boost following an earnings beat on the top and bottom lines. And then we have the hospitals. HCA Healthcare sinking amid a miss. The hospital operator attributing that to hurricane-related losses. And Universal Health Services, another hospital chain owner, lower today despite an earnings beat. The company beat earnings but also maintained its full-year guidance outlook. zeroing in on Centene for just a moment here, really interesting because we had United Health missing estimates, we had Elevance missing estimates, then we had Molina beating estimates, and now Centene beating estimates. So there seems to be a lot of confusion in the healthcare space about the costs related to patients right now, particularly patients who are covered by Medicaid and Medicare, and like how that's flowing through to these companies.
Yeah, and that was kind of the analyst commentary you saw on Centene too, right? A lot of better than feared quotes, which you can take that either positively or negatively, right? Because that really just means that sentiment overall in the stock hasn't been that high in some cases. And their analysts also pointing out that they're unsure about what the outlook is going into the fourth quarter and going into 2025. To your point, not a clear read through here yet on what this actually means long term, I don't think, and still very much a wait and see story.
And then just on the flip side quickly, when you're looking at UHS and HCA, it was the opposite. We've seen the shares of the hospital chains kind of run up into the earnings. And so that was part of the context for the shares then going down today.
Tough to beat that high bar sometimes, Julie. All right, next week is a big one for big tech with Microsoft, Alphabet, and Meta all set to announce earnings, and investors eager to find out how they've been faring amid ongoing macro uncertainty. Joining us now is Joe Bonner, Argus Research Securities Analyst. Joe, I want to start just macro here on the AI story with big tech. I felt like we came out of last earnings season with perhaps the market a little skeptical on the amount these companies are spending and how quickly it's going to feed back through into actual earnings and into profits. Do you feel like that's going to be under specific scrutiny coming into this quarter again? And is that a big part of what's going to be driving these stocks, or is it not as much quite yet?
Oh, I think it's still a very salient topic, particularly the cost of AI versus getting revenue in. In this race, Microsoft has been reporting AI revenue, so that's a positive for them. It's going to be a little bit of a messy quarter for them since they changed their revenue reporting, switch around business lines among segments. But we'll still be looking at that intelligent cloud segment. Within that intelligent cloud segment, the Azure cloud, and within Azure cloud, the contribution from generative AI. So definitely, it's still a salient point, and especially around costs.
Well, and Joe, how are you sort of thinking about that? I mean, as you wrote about Microsoft in particular in your note, Azure's obviously an important part of the business. AI is an increasing part of the business, but Microsoft does a lot of different stuff. And so do you think that the street is overweighting the importance of Azure right now, or do you think it's appropriate? How should investors be thinking about it?
Well, I do think it's appropriate because when you think about the intelligent cloud segment, which houses that Azure, that's been the growth driver over the last year or so. I mean, 20% growth, certainly growing faster than the other segments, the personal computing or the business productivity segments. So it's certainly a point of concern and a point of something that we'll be looking at it very closely.
Joe, I'm curious, when you look across the space at these companies, there's often a lot of talk about just simply the valuation, right? And at some point, are we going to keep extending in this cohort of these Mag 7 companies that are reporting next week? How do you feel like that weighs into this? Is valuation an issue for some of these names, any of these names, or is that not a top concern right now?
Oh, valuation is always an issue. What they need to do in the next week in the reporting is to prove that the returns will support that valuation. I think Alphabet may have a bit of a lead here, in that in terms of both revenue and EPS growth, strong double digit growth of each of those. So Meta also, Microsoft being the mega cap that it is, it's going to grow at a slower rate.
And you also talk a little bit in your notes, previewing in particular Meta and Alphabet, the regulatory risk that's hanging over each of these. I imagine there's not necessarily going to be a lot of discussion in these earnings calls about this stuff because it's still sort of up in the air in a lot of cases. But how should investors be thinking about earnings strength versus those risks?
So regulatory risk is certainly important for these companies. More so for Alphabet, more so for Meta than Microsoft. there's just a story about the UK investigating Alphabet for the same reason it let Microsoft go in terms of investing in AI. It is a risk for these companies. For Alphabet, there's all this talk about a breakup of the company. I think that's a very remote possibility. But certainly the idea of regulatory action to change the way they do business or regulate the way they do business, that's definitely on the table.
Joe, I want to stay on Meta for a second, move back to Meta, I should say. I'm curious, you called out Threads in your recent note, and it's something that I haven't heard as much, I think, in terms of the Meta story. Do you think that's part of the investor story here, growing Threads, or is that not going to be that big of a piece as we move forward? I know that's maybe not a this quarter story, but moving forward in the long term here.
Sure. I mean, I've thought it was a great idea that they came out with Threads, given the issues with X. Yeah, I mean, it's as long as it's competitive, I think they'll get that kind of they'll get a positive note. Just the fact that they're out there competing, I don't think it has to blow the doors off, really.
Makes sense. Joe, we're going to have to leave it there. Appreciate it.
Have a good night.
All right, coming up, Elon Musk is increasing his political donations for Donald Trump. But is that good news for the former president? We discuss when Market Domination returns. JP Morgan Chase CEO Jamie Dimon is usually one of the more outspoken executives in the banking world, but with less than 2 weeks to go before the presidential election, the leader of the nation's largest bank still hasn't endorsed either candidate. Will that change before November 5th? Joining us now with more is Yahoo Finance's David Hollerith. David, what's the latest with Jamie Dimon and the will he or won't he support a candidate debate?
Yeah, Josh, never say never, but by our reporting, the answer is probably a no. Yesterday, Jamie Dimon spoke in a conference in Washington, and he once again did not express support for either political presidential candidate. And that leaves him with exactly 11 days to give his public support. This is also important, too, because a source we've spoken with who's close with him has told us that it's likely not to happen before the election. Also, earlier this week, this came after The New York Times reported Tuesday that Diamond had privately favored Harris and also feared retaliation from Trump for any public endorsement. As we reported 2 weeks back, Jamie Dimon's private dialogue with both Trump and the Harris campaigns have been ramping up since the beginning of the fall, with more of the conversations leaning towards the Harris side. But to be sure, it's not exactly a standard for bank CEOs to give their support to one candidate or another or any. But Dimon's a little bit of a different case in that he's both a highly regarded CEO on Wall Street and also pretty blunt about expressing his opinion on a range of topics.
Yeah, he definitely has talked about politics writ large in the past. He also has been floated as potential Treasury Secretary, as you know. And we had a couple of people who had some very different thoughts on the shows as to whether he would be a good Treasury Secretary. They were Mark Cuban and Paul Krugman. Let's listen to what they said.
I'd love Jamie, and I think he'd do an amazing job. I think just having the conversation with him sends the message that Kamala Harris is a hardcore capitalist, that she wants businesses of all sizes to grow. She understands that if we're going to reduce the deficit, we not only have to cut costs, we not only have to improve efficiency, but we have to know how to grow the economy. And that's something Jamie has proven that he can do with his companies and in helping others.
He's a great businessman. I'm not sure that means he would be a great Treasury Secretary. They're very, very different skill sets. I mean, thinking about it, when was the last time we had a genuinely great business person as president? And the answer is, well, Herbert Hoover. So I'm not sure. I think that Dimon does a great job in his job. I'm not sure that I would think that he necessarily has the quite different set of skills that are required to be an effective administration economic official.
So obviously some interesting views on there. I mean, I don't know how likely it is that Dimon would serve in the next administration. Kind of what have you been hearing, David?
Well, I think to Krugman's point, that's got to be a factor of consideration is where would he think he could best do the most impact? And largely publicly, he said that's been as CEO of the country's biggest bank. But he's also been on the short list as a U.S. Treasury Secretary pick in multiple past elections. And he's also acknowledged this year that the timetable for his retirement as CEO is nearing. And so the chatter is as ever popular on Wall Street about talking about this. Our same source did tell us, though, that Dimon would consider a request for either candidate. He does not intend to serve in either administration. That's also sort of a refrain of what he said in third quarter earnings about 2 weeks ago, though it wasn't quite definitive. Our same source also added in conversations, Dimon has indicated he would only take such a job if he were to be able to do it without interference. And our source indicated that that would be not really possible in either future administration if he were to be offered the job.
Thanks a lot, Dave. Good to see you. Have a good weekend. Companies are wrestling with the timing of mergers and acquisitions as the presidential election is muddying the picture for antitrust enforcement. Yahoo Finance's Alexis Keenan joins us now with more. This is such an interesting topic, Alexis, because obviously Lena Khan, as head of the FTC, has been aggressive, assertive, however you want to put it. And there are a lot of questions about whether she'll keep her job. And even if she doesn't, what the policy stance would be under a different administration.
Yeah, and I can't even count the number of people, journalists, others, trying to predict, read the tea leaves for what would happen either under a Harris administration or a Trump administration. And we're already seeing some action, some maybe trepidation with M&A, with the election approaching here. You saw Qualcomm taking a pause on its considerations to acquire Intel, also Capital One Discover, originally wanting to close in December, and now saying it's looking more like 2025. Also, ConocoPhillips. also looking to push its close with Marathon after the inauguration. So with all that said, that is kind of a common thing that happens in an election year, and then it picks up again in December, typically. So the thing, though, here is there's no real solid indicator with as many people as I asked this question to try to read the tea leaves, no real solid indicator of how enforcement would look under Trump or under Harris. Some think that a Harris administration, Lina Khan or not, whether she keeps her job, would look like a carbon copy of the Biden administration's policy approach. Others say that the Trump policy would be more hands-off, but we don't really know. And so all we can do is really look at the record. So let's take a look at what Trump actually did, what Biden actually did. So under the Biden administration, you mentioned aggressive under Lina Khan and Jonathan Cantor at the DOJ. You did have a new merger guidelines that were issued, and this made it more lenient for the standard to even take a look at a company and question whether they have violated the laws can be done. So you've got Biden going after Google, Amazon, Apple, Microsoft, Visa, Ticketmaster, Facebook, JetBlue, and then Kroger Albertsons. That's just to name a few.
Tapestry and Capri.
Tapestry now, yep. And so then jump over and look at Trump. Okay, maybe not as aggressive on the litigation front, but going after Google, his administration filed that landmark case in the search case that is now partially complete. AT&T and Time Warner challenging that merger. Visa Plaid, but also some really novel theories going against vertical mergers came out of the Trump administration. In addition, the Trump administration brought a technology task force to the FTC that is now at least a permanent fixture as it's been since his administration, also launching investigations into Google, Apple, Facebook, Amazon, and Microsoft. So Trump has said a little bit on the campaign trail. He responded to Bloomberg asking about the remedy in the Google search case. We haven't really heard anything from Kamala Harris, but Trump said what you can do without breaking up Google is you can make sure it's more fair. So sounding like maybe the enforcement element, he would not support so much a divestment in the company.
Reading through your story, Alexis, I was curious about the Trump part because I thought from 30,000 feet, the read is just he's pro-business, right? So he's the better candidate if I'm in M&A and I'm interested in M&A, right? That would be the clear read. Why isn't that the case based on people you spoke with?
So I won't say there aren't differing opinions. Many people think that Trump would absolutely have a lighter touch. But I think you also have to recognize that his administration kind of surprised some people in the actions that it did file, more than any other Google, right? Because now we have Google search being deemed an illegal monopolist. Now we are facing a remedies phase and the potential that the company could actually be broken up into various parts unknown right now. So yeah, I think that is the knee-jerk reaction, but there's a lot of story to still be told here.
Well, as always in politics, there's the narrative and there's the reality.
Yeah, what they say versus what actually happens.
For the reality part. Thanks.
We're waiting. Yeah.
Alexis Keenan, appreciate you joining us. Elon Musk is increasing his political donations. The Tesla CEO adding to his support for Donald Trump and the GOP. Here with more is Yahoo Finance's Ben Workshall. Ben, I want to start with Elon donating more money here. Obviously, we know Elon is a rather volatile figure, I think is a fair way to put it, right? People feel very strongly about him, either for or against. Does this help Trump's case or hurt Trump's case to have someone like that continuing to pile more and more money into the campaign?
Yeah, I mean, so good to be with you. I do think it definitely helps on the money side. But Musk is a sort of integral part of the operation, and this is not small. This is not a small amount of money. He's put in $132 million total. What we learned about today was $56 million that he's put in just in a 2-week period at the beginning of October. So this is a lot. This is going up and down the ballot. A lot of this money is going for the Senate, but also obviously for Trump and Musk's super PAC, where he's kind of running his ground game in Pennsylvania and other states. To your question though about whether it helps, this is where I think it kind of gets more interesting. My colleague Rick Newman had a really interesting survey of Yahoo Finance users, and they found that actually more respondents said that Musk's support makes them less likely to vote for Trump than for. 25 for, 28 against. So it's close, but it shows that Musk isn't some sort of slam dunk for Trump in this thing. And there's been polling out there that showed that. So it's kind of a mixed bag for him. I think in about a week's or a couple weeks time after the election, we're going to be talking about this a lot. Like, was the Musk play, is that what brought it for Trump, or is that what ended up hurting Trump, one way or the other, depending on who wins?
Well, and every day there seemingly is a new headline about Elon Musk. I mean, there's obviously your reporting about the more money he's putting into the campaign. There's the sweepstakes he's been doing. And now the Wall Street Journal's reporting that he's been in regular communication with Vladimir Putin, which raises some eyebrows, I think, to say the least. So, you know, it feels like it feels like the playbook for both Trump and Musk is sort of like headlines are good. Doesn't matter what they are.
Yeah, exactly. Well, I mean, in this case, I think we're going to see headlines for weeks to come now on this. As you mentioned, the Wall Street Journal is reporting that what Musk has been in is what they call regular contact with Vladimir Putin since late 2022. And this raises a whole array of issues. Musk has a level of security clearance because he has government contracts. What is the interplay between that? But also, obviously, his sort of political involvements kind of play into all of that. And what NASA has said, the head of NASA has been saying since then, is he thinks maybe there should be an investigation of this. So this is just kind of an ongoing story. To your point, maybe all press is good press in the Musk-Trump world, but it's sort of hard to believe it doesn't raise some questions.
And we will see soon what difference, if any, it all made. Thanks a lot, Ben, for your reporting, as always. Appreciate it.
See you later.
Coming up, Fintech flurry. Earnings coming from SoFi and Affirm in the coming weeks. We're taking a look at the best ways to be positioned in the Fintech space with today's Investor Playbook. Stay tuned, more market domination still to come.
The S&P 500 has been on a tear in 2024, up over 20% so far this year. And while there may be some speed bumps in store for stocks before the end of the year, our next guest is staying optimistic on the S&P 500 in 2025. Piper Sandler Managing Director and Chief Market Technician Craig Johnson joins us now to discuss. Craig, 2025 S&P 500 target of 6,600. Just lay out the base case for us here. What are you looking at when it comes behind that target?
Yeah, thanks, Josh. Thanks for having me on the show. I think the base case format is really that this bull market that started off of the lows back in October of 22 is still fairly young at about 500, a little over 500 trading days. The median length of time that most bull markets have lasted have been around 979 days. And if we step back and just think about not only the length of these bull markets, we think about the Fed has now been lowering rates. We think about the yield curve normalizing. We think about the market broadening out, financials really starting to improve. And the fact that this bull market has also been led by more than just the Mag 7 stocks sort of is a positive indication to me that it probably has more room to run, Josh.
Craig, it's Julie here. One phrase sort of made me giggle in your report, I have to admit, where you said, our research shows that new highs often lead to more highs. Things are going higher because they're going higher. I mean, but obviously there's history and there's data behind that. How does that phenomenon sort of work?
So when we've gone back in time, we found that really the only way to change sort of a pessimistic mood on Wall Street is ultimately through new highs. And when we've gone back in the past and sort of looked at when you get 5 new highs, 10 new highs, 20 new highs, it seems to just keep progressing. And it sort of becomes a market where people start to chase it. And then I think more importantly, look at the composition of this market, how it has changed over the years. I mean, I don't think a lot of investors really realize that about half of all the equity dollars at this point in time are basically in ETFs. And therefore, I haven't found a single person that says, I'm buying this ETF because it's cheap. So it's become more of a factor, momentum, and sort of technical driven market that I think a lot of investors really haven't paid attention to. And hence, Julie, more highs lead to more highs.
Craig, you highlight the SMID cap space here, and you say you think that's going to outperform mega caps, I believe, over the next year. What's the case for that, for SMIDs to start participating more in this rally and leading?
Yeah, so Josh, what has been sort of leadership off of the lows of October 12th of 22 has really been technology. About 30% of the top 50 best performing stocks off of those lows have been technology. 28% for the S&P 500, that is overall, have been industrials. And when we go through and we actually look at what has led off the lows, it's interesting that from the analysis that we've done, only 2 of the Mag 7 stocks have been among those 50 best performing stocks. And so you go through and you start doing the analysis and you say, the S&P was up 62.6%. But the median stock was up 182.6%. And if you go do the same analysis on the Russell 2000, you'll see that on that particular index, you've got numbers that are almost 2x that, looking at the top 50 best performing stocks.
So, Craig, what's the biggest risk in this whole scenario? You know, what would sort of stop that momentum march higher?
Well, there's a couple things that can slow it down. First and foremost, we've got uncertainty around an election coming up and how quickly the results of this election are known, number one. Number two, what is going to happen on the geopolitical front? I think there's a lot of uncertainty around the Middle East and certainly around Ukraine at this point in time. I think number three is the Fed. Has the Fed gone and reduced rates too early? And then we start watching 10-year bond yields move higher in the face of the Fed cutting. That would suggest that perhaps they made a mistake. Any sort of reversing course from the Fed, which I don't think will be the case, would be some of the things that could certainly slow down year 3 of this bull market.
Craig, just quickly, I wanted to zoom in on the election piece of what you were just talking about. We talk to people all day long. If the election goes this way, if it goes that way, if the Congress goes this way, this is what's going to happen with stocks. In your view, is the quick resolution or not of the election more of a risk than the actual outcome?
It's a great question. So if I look at this by just purely looking at data, setting aside whether we are voting for Trump or whether we're voting for Harris, at the end of the day, if I look at the Dow as an example, going all the way back to 1900, the returns post-election to the end of the year, you have seen the Dow higher 61.29% of the time with a median return of 1.51%. If you do the same analysis post-World War II for the S&P, the median return is 1.78%. And if you do this analysis for the Russell 2000, you're up 2.85%, and the Russell outperforms the S&P by quite a meaningful margin, with the Russell outperforming 82% of the time. So the point that I'm making here, Julie, is win, lose, or draw for whatever candidate, markets tend to feel a relief getting this election done and over with, and the uncertainty goes away, and markets typically move higher. And whether that's going to be driven by earnings or just a re-expansion of the multiple of the market could be a combination of both, given the strength that you're seeing in the economy, which would ultimately be bullish for equities.
Craig, good stuff. Interesting stuff. Thanks a lot. Appreciate it.
Thank you for having me.
This week, Lending Club reporting strong third quarter earnings. It's not the stock soaring, but it could also be a good sign for companies like SoFi and Affirm. They're both set to report in the coming weeks. So how should investors be looking at these fintech companies? We're navigating how to play the fintech sector with the Yahoo Finance Playbook, sponsored by Tasty Trade. Joining us now, Vincent Kantic, Managing Director at BTIG. Vincent, thank you for being here. So is Lending Club sort of a good sign for some of these other fintech firms that we're awaiting?
It is. Thanks for having me. So we've had Lending Club report not only good fundamentals, but a lot of investor interest in its marketplace lending platform. So I think that's good for a lot of these other fintechs that are benefiting from not only this positive view about a soft landing or no landing scenario, but also increased investor demand, as well as the traditional forms of credit like credit cards starting to tighten up and therefore maybe drop some of their customers. The fintechs are picking up more volume as a result.
Vincent, you mentioned soft landing, no landing there. Obviously, we're talking about perhaps the consumer being able to keep spending, right, and the economy keep growing. How much of these stocks, how much of that is a part of the story here? If we were to have perhaps a hard landing or maybe not that aggressive of a soft landing, is that a key risk here still, or does the consumer spending story not add up apples to apples?
Yeah, it's interesting. For some of the names that I like, particularly Affirm, I think that they're going to be able to capture share from the traditional lenders like the credit cards, regardless of the economic scenario. But for some of these other names, you do have improving credit and improving consumer spending as part of that positive thesis. So there is some risk to these companies as a result of that. But for some of these, like Affirm and for Lending Club, which I have buy ratings on, I think that they can take advantage regardless of a no landing or a maybe not a soft landing scenario.
Well, and Vincent, what about the effect of rates, right? Because yes, obviously the Federal Reserve is cutting rates, but yields are moving higher. So how does that play through? We've talked a lot about how the big banks are navigating this. We've talked less about how these companies are navigating it.
Lower rates are positive for the fintechs. And the way we've been seeing that is from all these institutional investors that have been signing up for these fintech platforms. So for instance, when SoFi announced a $2 billion partnership, that sent the stock soaring recently. Same thing for Upstart, which announced its own $2 billion forward flow agreement. And the Lending Club most recently, alongside the strong fundamentals it had on earnings, also announced on earnings that it had an additional $1 billion forward flow agreement. So all that appetite coming from investors is in order to lock in these good yielding assets in a falling rate environment. So I think demand is going to increase and therefore drive upside for these fintechs.
Vincent, we're talking about rates coming lower, perhaps the economy holding up. I would think people are swiping their Amex cards in that kind of environment, but you downgraded Amex. What don't you like there?
It's an interesting situation where the fintechs are doing well and taking share. On the other hand, the traditional lenders are actually pointing towards consumer concerns. So even with American Express, which reported earnings last week and was down on its earnings, it was a bit of a surprise to the market that even the super prime customer, which is your typical Amex customer, is feeling more cautious about spending. So they're spending decelerations as well as they're slowing down their loan growth. So I think Affirm could take share as a result of that.
Lots to keep an eye on there. Vincent, appreciate you joining us today.
Yeah, thanks for having me.
Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime next.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day. Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. So let's see where the major averages ended the day. Still mixed, although we saw the S&P 500 dip into the red. Let's start with the Dow here, off by about 260 points, about 0.6%, leading the declines on the day and on the week on basically some earnings losers that dragged it down. The S&P 500 had been higher on the day, then slipped into the red by day's end here. It's also lower on the week, breaking a long weekly winning streak. But the Nasdaq was the winner of the day, off the highs of the session, as you can see here. Still up, though, a little more than 0.5%, ending the week strong in terms of large cap tech, seeing a comeback in some of the chip names, for example, and the Mag 7 ahead of some of the earnings picking up in that sector next week. So interesting action there. One more thing I want to mention is what we saw from the bond market, which we have been watching so closely here. Yesterday, we got a little relief on yields, which started to come down. They started to come down this morning and then rebounded into the afternoon. And even though, of course, Jared, we're going to be watching economic data, we're going to be watching big earnings next week, we are also going to be watching what's going on with yields to see if that trend continues.
Yes, we are. And, you know, it's interesting. I was just looking at the 10-year T-note yield, now above the dividend yield of the S&P 500. So long conversation to be had there. But I think it's instructive that the Nasdaq and the S&P 500 going different directions today and for the week. That streak that you mentioned, Julie, ending, that's 6 weeks for the Dow and the S&P 500. It continues on for the Nasdaq. But we've seen different parts of the market reasserting. And this week, here's the sector action. Only consumer discretionary in the green, and that is simply a Tesla story. If you take a look at the losers, we have a number of markets down more than 2%. We have materials there, healthcare, industrials, financials. So for the most part, we did see some downside action, especially in the larger issues. And taking a look at the leaders, it was home builders and retail stocks. So you might remember consumer discretionary was the best performer. How does that score with retail? Well, again, gets back to Tesla, a member of consumer discretionary, but not XRT here. Aerospace and defense suffered. That was down about 3.4%. Small caps as well. So, Julia, I think the bond market really did cause a little bit of consternation for the markets this week. And send it back to you, Josh.
Jared, appreciate that breakdown. For more on the market moves this week, let's welcome in Linda Dissel, Federated Hermes Senior Equity Strategist. Linda, I want to start with looking ahead to next week. We just talked about the tech rally that we've seen over the last 2 days. I'm curious, is it going to be big tech earnings? Is it going to be the jobs report? Is it going to be inflation? There's a lot of things that could drive this market over the next week. What are you watching?
Yes, well, good afternoon. Thanks for having me back again. It's difficult with the jobs number, which of course we always look at that very closely at the beginning of every month, but it was a really messy month with the hurricanes, and some of the things that have just distorted those numbers. So I don't think it's so much of that. As you bring up inflation is something now that is starting to come back into concern, I guess, for some. When you saw the strong job market last month and then maybe the CPI a little bit hotter than we would have liked. oh, could we be going back into an inflation scare? But we don't really think that that's going to be the case. Tech stocks are very, very important. Of course, they're the biggest sector and some of the biggest names in the market. And they have been the most valuable names, most expensive names. So yes, I think that's going to be the one as we continue on through this earnings season to see, will they disappoint? Will they miss whisper numbers? And of course, if they do and have a pullback, that could really hit the top, top of the index there.
Linda, how are you all positioned in large cap tech going into those numbers?
Interestingly, that's the one area of the marketplace that in our asset allocation, we're suggesting an underweight because while we appreciate the strength of these companies, they are really fairly expensive as a group, I think 28 times now. And when you strip away those companies and you look at the rest of the S&P, it's selling at just a 17 times multiple. So if we say, well, we believe, as we do, and I think as consensus now agrees, there probably is not a recession next year, then why can't I bid up the cheaper areas of the market, starting with the large cap cyclicals, which seem to have worked out, as you know, with the financial sector. So why don't we just let them take a rest? Not really expect them to do anything terrible, but let the rest of the market catch up with them. That's a continued healthy broadening. And actually, you've seen that. I think now 80% of the names in the market are up over their 200-day moving average.
Linda, I'm curious, I think about 40% of the S&P 500 has reported at this point. What's your takeaway been from earnings season as far as how stocks have reacted, how stocks are reacting, that whether they beat on earnings or don't beat on earnings, and sort of the price moves we're seeing the day after? What's that telling you right now about the market action?
Yes, well, I think what we've seen is that for the most part, if they beat, then their reaction is probably a little bit, it's normal, probably average, normal, a little bit better than normal. But it is interesting, like on a name-by-name basis, which I have thought was really fairly uncomfortable for over a year now, how names can just be hit 10% or more on a particular day or really rise dramatically. I think you mentioned Tesla, and I don't speak on behalf of any individual name or Tesla, but wow, to see it go up as dramatically as it has in the strength of its earnings figure, that's a lot of, a lot of fast money, a lot of quick rotation money out there, which is not the best.
Linda, I want to switch to the election because I know you've written about it a little bit. And I'm actually going to pose a question to you that I posed to Craig Johnson over at Piper Sandler in the last hour, which is, does it matter so much who wins or loses the election as how quickly it is actually resolved and that we know who the winners are both on the presidential level and the congressional level?
Well, it's as we continue to hear, it's very likely to be a contested result because going into it, we're so very tight. And with our country so divided as it is, you could expect a contested election. We had a contested election back in 2000. It was resolved. Gosh, I think it took into January before it was resolved. The markets didn't seem to care that much, though. And if you go back beyond that, back into the late 1960s, I believe it was 1968, you were having assassinations at that time. You had a contested election at that time. You had riots going on, and the market seemed to continue apace. So I think that history tells us maybe not to worry that way. And then, gosh, if we look at this year, could you have ever dreamed up the year that we have been through here, this election year? And the market just continues to make new highs. So we wouldn't think that should be the issue really at all. Rather, corporate profit margins are at all-time highs today. That's powerful and hard to argue.
Linda, I want to stay with what you just brought up. It's been an abnormally strong election year, right? And we didn't really get the typical October volatility we would see. I think the VIX is still sitting below 20 right now. Is that a concern that we haven't had the volatility come yet? Or are we just waiting for it to come? Is it something that's going to come, in 2 weeks? Is it something that's inevitable and we just haven't paid that price yet?
Yeah, it's like all the old adages just start working for us, are they this year? And we are coming into this election day with, I guess today we made a new record high on the Nasdaq, very recently a new record high on the S&P 500. And in this market deserves a correction. It deserves really a 7 to 10% correction. And we are expecting that at Federated Hermes. I'm actually writing in my weekly this week that I wonder if in this rarest of rare election years, The correction comes after the election. But whatever, it's very, very difficult. You know, you've had a 30% plus year in the market, and that doesn't happen very often. The last 21 out of the last 21 times it did happen, 19 of those times, you didn't have a recession for at least a year. So that, I think, you know, when we sit back and we try to take our minds off of this crazy election year and the emotions and et cetera, and look at the fundamentals of this economy, the earnings are great. The employment is still really quite good. And we're out there spending. So it's hard not to be a bull.
What brings that correction, though, then, Linda? If it's not the election, is there something else you're watching that you think could bring that correction?
Well, it's, you know, it's really can only really boil down to two things. One, do we have a new inflation problem, and the Fed shouldn't have cut it 50 basis points as it did? If you would overlay the inflation situation today and its trajectory, really, since we started with the 40-year high back to the 1970s, and you overlaid it with kind of the trajectory that we did back in the 70s, where they claimed victory on inflation 3 times and they were wrong. We are right on course to maybe see that turn around. And so when you look at the 10-year Treasury bond yield going up and you're like, what is up with the 10-year Treasury bond yield? Could it be all about a concern for a Trump win? You know, and so if that number should go up towards 5 or over 5% on the 10-year, people might start wondering if the bond market knows we have an inflation problem. We don't believe that at Federated Hermes. We believe that we're probably settling in at a 2.5% level, which all the main inflation figures are at right now, which may be where the Fed really does claim victory. Then you got to look at the job market. The problem with the job market is it can be fine, and then all of a sudden unemployment spikes. And that's what we have to watch for. But even then, it's hard to get too bearish, only because we start at such a very low level on the unemployment rate.
Linda, good to see you. Thanks so much.
Thank you very much.
Coming up, it's What to Watch for Monday. We'll get you set with everything you need to know so you can kickstart your trading week. Stick around, more market domination overtime still to come. As clean energy becomes a bigger topic of conversation, so too does the demand for carbon credits. But for the second consecutive year, carbon offset purchases are declining. So how should investors be thinking about this space? For more, we're bringing in Talal Debs, founder and managing partner at XMC Strategies, as well as Yahoo Finance's Akiko Fujita. Thanks so much for being here, Talal. First of all, sort of describe to us what it is that you do. We know that you invest in these credits. You use sort of aging oil and gas assets in some cases, but sort of lay it out for us.
Oh, thank you very much for asking. Yeah, we actually address the full spectrum of what we call energy transformation, which means that we want to take the existing infrastructure in our country, which has been so productive for many years, and help it transform into its future. And one of those things is to clean up old oil and gas wells, which are leaking methane into the atmosphere. And one of our portfolio companies, Zafiro Methane, is focused on doing that and getting that financed through the carbon credit markets.
Akiko?
Talal, specifically, who can invest in this? I mean, we talk so much about carbon credits. For our viewers, it's sort of, where do I fit into the piece of all of this? Who's investing in XMC right now?
So XMC is a private equity business, but our companies can be invested in, and Zafiro Methane in particular is a public company traded on the CBOE in Canada. So retail investors can certainly invest in Zafiro and get exposure to carbon credits because we think that company will be the premier producer of carbon credits in the sort of carbon 2.0 that we expect to be blossoming coming into the next 12 months.
Well, that brings up a good question, the nomenclature that you just used, which is the premier producer of carbon credits. There's not really any sort of global definition regulatorily for what premier means. What is a good carbon credit? What is a not as good carbon credit? How are you thinking about that?
Thanks for asking. So I first developed a view on this in around 2007, 2008, end of 2007, beginning of 2008. I was at my old employer, JP Morgan. We were just getting into the carbon business, and one of my jobs was to develop a view on what were the kind of carbon credits that a conservative bank like JP Morgan could buy. And I've used those insights into designing Zafiro's carbon credit offering. They are very simple, easy to understand carbon credits, very verifiable, and very interchangeable from one carbon credit to the next. A lot of carbon credits that are out there, that have been out there, don't have those capabilities and those qualities, and I think that's limited their uptake.
Talal, one of the challenges in determining what is a quality credit is the lack of sort of comprehensive regulation around this. I mean, what do you think the demand picture will look like? How does that shift as we start to see regulation form around this?
Well, look, every economy has a different view on the balance between regulation and market factors. And the U.S. is usually leaned in the direction of more market factor and less regulation. And I think the carbon markets in version 2.0 will prove that out again. Rather than legislating a carbon market, what we have in this country is essentially companies that have committed to reduce their carbon footprints through their net zero commitments, and those are global companies. And one of the few ways they can do it is to back projects like ours in financing the cleanup of, in our case, oil and gas wells, but numerous other projects in that market.
Talal, who do you see as the main customer buyer of the credits that you are developing?
So we see ourselves as a high quality, low cost, high volume wholesale provider of carbon credits at Zafiro. And so we have already sold and announced sales to some institutional intermediaries, and we expect to continue to do so. So we want to provide the market with high quality and let the usual intermediaries, the banks, the broker-dealers, maintain the relationships with the end customer.
Thanks so much, Talal and Akiko, for pitching in. Appreciate it.
Thank you.
Markets have been on a volatile ride in recent months, with more volatility potentially underway next week. Investors keeping an eye on fresh economic data, as well as big tech earnings such as Alphabet, Meta, Microsoft, Amazon, and Apple, all set to report. With options trades up for grabs for those big tech companies, we're taking a look at the best way to play the options market. Senior option strategist Brian Overbeek joins us now to discuss for the Options Playbook, sponsored by Tasty Trade. Brian, I want to start with those big tech earnings. So if I'm looking ahead to next week and I'm interested in playing options on some of these earnings that are going to be announced after the bell, what should investors be looking at? How do you make a decision on where you want to play options? What companies are the best to do that with? How do you assess it looking ahead to next week?
Well, around earnings, you're always going to be speculative in nature in the trades that you're making with options. So one of the biggest things that you want to establish, first off, is what the expected move is after that earnings report. And the marketplace will tell you that just by looking at the nearest term option contract. So next week we have Google, Microsoft, Meta, Apple, Amazon, all the mega cap tech stocks are going to be announcing earnings, and Google is kicking it off first, and Google actually has an expected move about 6.5%. And then we're looking at Microsoft. They're looking at an expected move around 5%. Meta's at 8%, Apple's at 4%. A little less volatility when you think about it between Meta and Apple. But what the stock that I'm kind of looking at is Amazon. And Amazon is looking for an expected move around 6.5%, which is really about 12 points. So if I'm setting up a trade where I want to be bullish or bearish, because you got to realize that has nothing to do with if the market's going to go up or down. It's just saying that after the earnings report, the marketplace is looking for a move of about that nature. So you want to fit that into your forecast. So in Amazon, they're going to be announcing on Thursday. The Friday option contract's got one day to live. And I'm looking at doing a long call spread going into that earnings date. And I want to make sure that the strike that I'm selling in that position is going to be within that expected move. And that's how you should always approach these speculative trades around earnings.
Brian, I'm curious, you brought up Amazon. They report Thursday. Friday morning at 8:30, there's a rather big macroeconomic release looming too, right? With that jobs report that can sometimes move the market and move large stocks like Amazon. How does that factor in when you're looking at this? Is that a concern that Amazon could have good earnings, the stock could be up after hours, but then by the time the market opens, perhaps a bad jobs report is just weighing on sentiment overall?
And there is some truth to that. But ideally, when it really comes to earnings, most people are looking at what is happening within that sector, within the overall space, and what other companies are announcing. Now, the macro event also plays a big effect. And just in general in the marketplace, we're seeing a great example today where we saw the market actually end up and then close down a little bit. But we saw the VIX spike up above 20, the volatility index, i.e. the fear index. So that does play a role in the general market conditions, but we're doing a one-day event just in Amazon. If I'm just speculating on that with option contracts, I'm not quite as concerned about the overall macro event, i.e. the jobs report in the morning.
Let's talk a little bit more about the VIX, because I think we've all been sort of trying to figure out what's going on there, right? What's sort of driving it? To your point, on these days when stocks are higher and the VIX is higher, it's a little bit confusing. What do you think's going on?
Well, I think what's kind of happening is that the market wants to go higher is what my feeling is. And one of the biggest things that is holding it up is the election. And we've been talking about a lot on Yahoo Finance today. And the fact that the VIX means that people are buying protection. When you see the VIX go up when the market is going up, usually that means that a lot of people are buying out of the money puts, and that's what will drive the SIBO, the VIX volatility index, higher. So it just means there's nervousness in the marketplace. So what we've seen since August is quite a few rallies and then get sold off. A rally again going into October and getting sold off just recently. And that just seems to be the theme. And to me, that means that the VIX has a hold on the marketplace. And every time we get a little bit of a run up, people run to the marketplace to try to capture it and try to buy some protection for their portfolios.
Brian, so what's the trade on the VIX then?
All right, so if I'm looking for a trade on the VIX, what I would look to do is to get bearish after the known event, the big election. So with the VIX right now trading, well, when I looked at setting up the trade, the VIX was right around 19. Today it closed right around 20% implied volatility. So what I'm going to do is I'm going to buy the 19 strike put in the November 20th expiration. So we're going out quite a bit after the known event because obviously a little bit of concern about when the election results will come out. And then we're going to sell the 16 strike put because one of the things about the VIX index is that it's a mean reverting index. It wants to go back to the normal range. And in this instance, that's usually around 15, 16%. And even if the markets don't consider what happens on November 5th to be a good thing or a bad thing, I just think getting rid of that known event is going to help the VIX settle in and the market do what it wants to do. So my whole goal here is to buy the VIX index and speculation that after this known event on November 5th, that the VIX will eventually start drifting down and be lower by the end of November.
Brian, thanks a lot. Appreciate it.
All right. Thank you.
Time now for what to watch next week. It's a big earnings week, of course. 169 S&P 500 companies are reporting results for the third quarter, including more Magnificent Seven names with Alphabet, Meta, Microsoft, Apple, and Amazon. Apple announcing results for its fiscal fourth quarter on Thursday after the close. The company jockeying with NVIDIA today for the top market cap in the U.S. NVIDIA just briefly passing Apple. Analysts do expect for Apple that China iPhone sales will be a focal point of the earnings call, as reception in the U.S. for the iPhone 16 has been sluggish.
Taking a look at the economy, monthly PCE data for September, that's personal consumption expenditures, is coming out on Thursday. Economists forecasting both core and total PCE to speed up compared to August, with core PCE at 0.3% and total PCE at 0.2%.
Moving over to jobs, the October jobs report is out on Friday. Non-farm payrolls and hourly wages expected to slow, with payrolls coming in at 108,000 and wages at 0.3%, while the unemployment rate is predicted to hold steady at 4.1%.
That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it is Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern. and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Markets ending the week on a mixed note. Overall, a tough one for investors as rising bond yields weighed on the equity market. We've got the takeaways from the trading day straight ahead. And the battle for your shopping dollars. The competition between Walmart and Target always tense, but Walmart has been leading the way, especially as consumers seek out cost savings. That said, recent discounts at Target have had more people coming in the door, according to one analyst. We'll get those details coming up. And one of the buzziest trends in the alcohol business is going buzz-free. The rise of non-alcoholic wine and spirits highlighting a shifting tide in consumer taste. We got the founder of one winemaker that's jumping on that trend to take a closer look. Well, markets closing mixed to end the week as Treasury yields ripped higher. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways, really breaking a weekly winning streak for stocks.
Yes, we did. We broke two, but we actually continued to. So let me just break that down. The Dow and the S&P 500, they were running 6 weeks straight to the upside, by the way. They have now basically flattened that. So they are no longer in that streak. But the Nasdaq Composite and the Nasdaq 100, they have extended that to 7 weeks here. Why am I talking about this? That's because they've been moving in opposite directions on certain dates, and it gets back to sector rotation. So I thought we'd show just the sector action this week. As we were noting a few minutes ago at the close, consumer discretionary, the only one in the green. That's thanks to Tesla being up 20% in one day. For the most part, I think the higher dollar and the higher bond yields have kind of been eating into equity returns.
Yeah.
So.
Yes. And one of the things that you and I were talking about earlier is buybacks, sort of providing a bit of a floor under the market. There are times that companies can buy back stocks and there are times they're not allowed to.
Yes.
Where are we?
All right, so we are just emerging into the time of year when companies can buy back their own stock. This is tied to the earnings cycle. So when they're going through earnings announcements a few weeks before, sometimes a few weeks after, they don't want any, or not after, but before, they don't want anything dissuading the public. So they will have to cease their buybacks, but that is now resuming. And so this is something that happens 4 times a year, earnings 4 times a year. And here's Goldman Sachs. We maintain our 2024 buyback growth forecast of 13%. So 13% ahead of last year, and also introduce a 2025 forecast of 15%.
So you got a big buyer in the market.
Yes, and as you can see, this goes all the way back to 2011. This is almost $1 trillion worth. So this is just a huge bid. In fact, they're saying in November alone, this is worth $6 billion worth of daily VWAP demand.
Wow.
So that's just another, kind of backdrop to the stock market. And we're thinking, all right, all the election uncertainty, that's over in November. You might start thinking a lot of this has been pulled forward, but I don't want to get
fingers crossed, by the way, that it's over in November.
Yes.
Well, yes, we talk a lot about the Santa Claus rally, yada, yada, but
yes.
You've got a little maybe Halloween seasonality to talk about too.
Trick or tendies, come on. There are a couple different ways we could go with that. But this is much like the Santa Claus rally, which is the last few days of the year plus the first few of the next. This is the last 4 trading days of October. So we capture Halloween and then the first 3 trading days of November. Over the last 30 years, most of these markets have been up 25, 23, 24, 25 of those 30 years. So the Dow has an average return of almost 2%, the Nasdaq 2.43%, S&P 500 a little bit more than the Dow, almost 2%, and small caps, Russell 2000, 2.34%. So not as well known as the Santa Claus rally, but I think another one that the history books have anyway said is very consistent.
Trick or tendies, I guess tendies in this case.
Yes.
All right, thanks a lot, Jared. In the fight for America's shoppers, Walmart still dominating Target. Year to date, shares of Walmart are up nearly 50%. Target shares up just about 7%. Brooke DePalma joined us now to break down what is driving the momentum for Walmart. Hi, Brooke.
Hi, Julie. Walmart certainly keeping up the momentum that we've seen in recent years as consumers really look for those value deals, for those low prices, especially when it comes to groceries. And that's what Walmart dominates at. Groceries make up about 60% of Walmart's U.S. sales. It's also known that grocery prices at Walmart are about 10 to 12% cheaper on an average basket of food. Target, on the other hand, well, it only makes up between 20 to 25% of sales. And so Target falling a bit behind just in terms of what exactly the consumer is seeking right now. But what we do know is that Target has taken major price cuts in order to entice consumers and get that foot traffic back in. We know they lowered prices on 5,000 goods. Now they plan to lower prices on another 2,000 goods ahead of the holiday season. And should discretionary come back after it's been down for 10 quarters, there's some on the street that are optimistic that it will come 2025. That'll be good for Target.
Yeah, we always talk about them, vying for shoppers. But of course, these companies don't just make money from shoppers, actually.
Exactly.
Advertising is an increasing part of their revenue stream through e-commerce. So what are we hearing from Walmart on that front?
Yeah, these higher margin businesses doesn't just have Walmart excited, but definitely has investors excited as well. We know that Walmart has been investing in their ad business called Walmart Connect. And that's actually grown about 30% year over year. Now, Target does have an ad business. They don't discuss it as much, but it's called Target Roundel. And what we know is that they do expect to end the full fiscal year in the high teens growth year over year. And another higher margin business that they're definitely looking at, Wall Street's keeping a close eye on, is e-commerce. We know that Walmart's e-commerce business is not profitable yet, but Wall Street's certainly keeping an eye on that, and also keep an eye out on memberships. Walmart has a membership that they launched back in 2020. That goes for about $98 a year. Target just came out with their membership model this year. It's $99 a year. So Target has a bit of catching up to do when it comes to this membership business. Walmart's had it for a while, but certainly between e-commerce, their ad business, and membership, all these retailers are really seeking other ways to make money.
I did not realize that Walmart's e-commerce business is not profitable.
Just yet. Working on it.
Okay, interesting. Thanks, Brooke. Well, with Halloween just days away, it's a matter of time before holiday music starts creeping onto playlists and everyone starts shopping for gifts. Joining us now to discuss the state of the consumer and how retailers like Target and Walmart are positioned heading into the holidays and before then, RJ Hadavi, Placer AI, Head of Analytical Research. Good to see you here. So you just heard the discussion we were having about sort of Target versus Walmart, what's getting people in the door. You guys look at how many people are coming in the door.
Yep.
So what are you seeing in terms of those trends between those two?
Yeah, it's very interesting. I mean, I think if we look at this year, it has really been a very deal-driven consumer. We've actually seen visits up in the low to mid-single digits for much of retail, but honestly, we've seen a little bit Target and Walmart both ahead of that as those rollbacks on those different products came in. Been very good about driving visits and taking share from, I think, traditional grocer, from restaurants. I think it's been very interesting to that. We also see a very holiday-driven consumer. That's one of the trends that we've observed the last couple of years, is that a lot of that, softer spending takes place during the shoulder periods, but people are willing to come out for holidays, whether it be early season holidays, Valentine's Day, Mother's Day, Father's Day, or back of the year holidays. We're seeing early progress on Halloween, starting to see even holiday promotions, as you pointed out, as early as October. Some of that has to do with the shorter window this year. But generally speaking, a lot of visits, but it's also a consumer that's looking for deals, maybe spending less per visit, but at the same time, healthy visitation trends.
Yeah, I was going to ask what you're seeing around deals, around promotioning, and whether there are significant upticks in traffic. I know, like, Target has something it calls Circle Week, which is its membership program, but it offers deals during those times. Does it see an increase in traffic?
They do, and we generally see this halo effect with the mid-October promotion period that we're seeing, and whether that's Target Circuit Week or Walmart's promotions or Amazon Prime Deal Days. Certainly there's a halo effect, and we generally see some pretty good strength around that. For the retailers, they're testing the durability of their supply chains ahead of the big holiday push. Maybe they're even looking to clear inventory a little bit earlier, again, given the shorter window this year. But generally speaking, we do see a nice pickup. Saw about a 2% lift in the week that Target had the Target Circle Week. So we do see a pretty good pickup, and consumers are definitely responding to the deals right now.
Let's take the deal topic and move it over to an area you know a lot about, which is fast food. Fast food getting a lot of attention this week. McDonald's having that E. coli outbreak. Starbucks coming out with pretty dismal numbers for this most recent quarter. How much is value, driving the conversation there also?
It's a big part of the conversation, and frankly, what we're seeing is a little bit of a slowdown across the QSR sector and restaurant space in general, as some of those summer promotions, that some of the value wars that we saw running in June and July have started to pare back. I think a lot of the retail or the restaurants are in a wait and see mode. We drove people in during those months. What kind of visit frequency do we get after that? Did it help to drive incremental visits after that initial promotional period? Right now, data says it's been a little bit slow there. We see a lot of that traffic going back to the grocery store channel, to Walmart and Target, to the Aldi's and value grocers of the world. So that's where we're seeing it. So value is very much front and center. We did see a pullback in some of the promotional activity from the QSR and other restaurant chains. And right now we're seeing that visitation trends shift back to the food at home channel, if you will, and away from food, away from home. And so it'll be interesting to see how that plays out. We do see a little bit of pressure there. We are going to see McDonald's run their $5 meal deal promotion at the end of the year. Obviously, there's some distortions with the E. coli news. A little early to see what the visitation impact, but we'll have some more news on that next week. But it's been interesting to see what's going to happen on that category.
Yeah, definitely. We're going to keep an eye on this. So that's really interesting what you're saying between the food at home, fast food sort of migration back and forth. Just to zero in on the McDonald's situation for a second here, RJ. Chipotle, of course, has had this kind of troubles in the past as well, and saw a pretty sustained dip in traffic. What did we see then? And as you say, it's early days, but how is that sort of applicable to McDonald's now?
Yeah, I think there's really two differences here with the Chipotle situation. One is they were never able to identify what happened. It was always kind of a mystery. And so at the same time, a lot of consumers were wondering, is my food safe? They never could figure out exactly what product it was, what stores we saw the impact from. And so I think that led to a lot of questions and a lot of uncertainty for consumers. So I think that's the big difference. I think McDonald's has come out and pretty clearly identified what the cause was and have put together a pretty good game plan. At least we'll articulate that, I think, next week. The other big difference, too, is Chipotle really had a double whammy. It wasn't just the E. coli. They had a norovirus situation immediately after that. And so I think if you compare the two, there obviously are similarities. There's some, shock to the system for consumers when they hear this. There's usually a pause. And, I think it's pretty obvious we will see an impact of visitation trends. But it really comes down to being able to identify the problem and communicate what they're doing to solve and prevent that from happening. And I think McDonald's has done a good job in that. So it may not have the same impact as we saw with Chipotle. Chipotle, it was kind of a snowball effect. You saw continued bad news, and really there were still a lot of questions that couldn't be answered. This is a case where I think McDonald's has at least a pretty good handle on it. Certainly there's going to be an impact. It is going to turn off some consumers, but at the same time, I don't think it's going to have the same impact. But there are still some questions that need to be addressed.
RJ, thanks a lot. Good to see you.
Thank you.
Stick around. We've got more Asking for a Trend still to come.
Are you a passionate investing bull? Maybe love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
You might have heard of Dry January, but the Sober Curious movement has now added Sober October to its calendar. Joining us now to talk more about the non-alcoholic industry is Rachel Martin, founder of Oceano Wines and Oceano Zero. And then, of course, there are people who are sober curious or mix it up all year long and don't need October or January to do it. Rachel, thanks for being here.
Oh, thanks so much for having me.
Now, I think your path is really interesting because you're a winemaker first. You make regular with alcohol wines, and then you decided to develop non-alcoholic wines. So talk me through that journey and how that ended up.
Well, I've been making wine for about 20 years, starting with my family's winery, and then I founded my own winery, traditional wine, Chardonnay and Pinot Noir. And then I noticed the trend of non-alcoholic wines and the Sober Curious movement. So I did my bit of investigating, tried everything that I could find. And what was lacking was quality and talk about vineyard and things that really make wine special. So I decided that since I'm already producing ultra premium wines, that I could pivot, if you will, and add the non-alcoholic wines to my portfolio. And now we're doing reduced alcohol as well.
Oh, interesting. And when did you start doing the non-alcoholic wines?
We launched last year in October, in fact.
So it's a 1-year anniversary.
It is. We launched with the Pinot Noir, ultra premium, single vineyard Pinot Noir. We work with grape growers, so it's really important that non-alcoholic and low alcohol wines can continue to support the wine industry and the grape growers as alcohol consumption wanes.
I'm always curious about how this stuff gets made. I don't know how much you can say for proprietary reasons, but obviously wine is a fermented product. That's what creates the alcohol. Do you then reverse it and take it out, or how does that work?
Yep, so we make our non-alcoholic and low alcohol wines just like our traditional wine. So we start with sustainable vineyard practices and we hand harvest, goes to the winery for, very high quality crafted alcoholic wine production. And then at the last step after aging, we remove the alcohol by a process called spinning cone column. And then we add a little bit of sugar to balance the lack of alcohol, which we actually, our non-alcoholic wines are the lowest calorie non-alcoholics out there. Our Oceano Zero is the name of our non-alcoholic line, and our Pinot Noir is only 5 calories per glass, and the Chardonnay only 6. So it's low calorie, ultra premium with minimal ingredients.
And what kind of demand have you been seeing for these products? I mean, you and I were talking a little bit off camera. We've talked to some folks in the beer industry who have gone non-alcoholic. That is more of a sort of visible growing area, but wine obviously is part of the equation too.
What's really interesting is since non-alcoholic wines are pretty hard to find, especially really high quality, people are searching on the internet. So we've been discovered by consumers looking for non-alcoholic wines, which increased our sales by 500% online. But what's really interesting is it also increased our alcoholic wine sales by 200%. So what that tells you is people are moderating. They're not necessarily a sober consumer, but they're a sober curious consumer.
So you didn't have as much of an online business before, and this has kind of made that explode.
This definitely boosted us big time online. We had some sales. We had the COVID and things went up and down. However, it really was the launch of our non-alcoholic wines that we really saw this boost in sales.
Really interesting stuff. Rachel, thanks for coming in.
Thank you so much. Thank you.
Coming up, we're dissecting our chart of the day, mapping out the correlation between economic data and yields. More asking for a trend on the other side. For our chart of the day, yields and economic surprises. Yahoo Finance's Josh Schaefer joining me now with a closer look. Hey, Josh.
Hey, Julia. So what we're looking at here in purple is the 10-year Treasury yield, which has been recently picking up. And so we were curious, why has the 10-year Treasury been moving up, right? And Callie Cox over at Red Horse Wealth Management slapped the Citi Economic Surprise Index on this chart, and it helps explain why. So the Citi Economic Surprise Index measures how much economic data is coming in better or worse than expected, worse than the street was expected. You can see here, that's been picking up. So part of what we've seen as this big move in Treasury yields that we've been talking about a lot on the show, what's actually been pushing that higher, part of the reason it's been moving higher is because economic data has come in better than expected and has been moving higher. This, we were talking earlier on the show to Zach Hill, the head of portfolio strategy at Horizon Investments, and he said that this could actually be a good sign. Even though yields are going up, sometimes that's bad for stocks. Zach says that might not be bad. Let's take a listen to why.
Why are interest rates moving? If rates are moving down because the Fed has got to cut more because we're going into a recession, that's not good for equity markets, even though policy is going to be easier. Conversely, if interest rates are going up because economic growth is stronger and we can live with higher interest rates, the economy's steady state is just a little bit higher than it was in the 2010s period, which certainly is the way that we lean in terms of how we're thinking about rates, then that's not a bad thing for equity markets. That's actually quite a good overall environment.
So Zach pointing out there, really the market action that we've seen over the last month, right? So I have the 10-year up here. You can see yields have been coming up for the last month. Let's flip over to the S&P 500 and look at what that's been doing for the last month. That's been going up because, as Zach said, if this is because economic data is coming in better than expected, that's a positive sign for corporates. That's potentially a positive sign for earnings. I want to flip back to the 10-year one more time here just to point out when this hasn't been a good scenario. So the reason we're highlighting this is because of this move we saw back in March and April. 10-year yields rose above 4.5%, a level that strategists tell me is perhaps a key level moving forward here as we've been moving up. And that is what caused part of the weight on stocks. We had that 5% drawdown in April, seemed to be partially driven by that move higher in yields. Right now, Julie, though, it seems like everyone is relatively okay, even though we're watching the 10-year shoot up quite significantly.
Yeah, we'll see if there's some sort of threshold where that starts to change, but I guess we haven't gotten there yet. Thanks, Josh. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great weekend.